Basic concepts of trends. In this video, you will learn what is a trend, trend directions, and trader decisions. What is a trend? A trend is simply the general direction of the market. Markets don't move in a straight line, but instead move in zigzags, creating tops and bottoms. It's the sequence and direction of these tops and bottoms that identifies the trend. Price movement has only three directions: uptrend, downtrend, and range. An uptrend is described as a series of higher tops and higher bottoms. But first, let's define tops and bottoms. After a series of green candles, the appearance of at least two red candles confirms a top. And after a series of red candles, the formation of at least two green candles confirms a bottom. As the market continues higher, breaking through the previous top and reaching a new high, the formation of two red candles confirms a second top. Then the market moves down until we see two or more green candles forming a bottom. Notice at this point the pattern we have in the market: one top higher than the previous top and one bottom higher than the previous bottom. As Charles Dow stated, if the market breaks above the second top, the market is considered to be a confirmed uptrend. As long as each top is higher than the previous one and each bottom is higher than the previous one, the uptrend is intact. This is what constitutes a well-structured uptrend. A downtrend is just the opposite: lower tops and lower bottoms. As long as each top is lower than the previous top and each bottom is lower than the previous bottom, the downtrend is intact. This is what constitutes a well-structured downtrend. The third market direction is what is known as range. A range is characterized by a series of tops and bottoms at around the same horizontal levels. The market moves in a sideways price pattern without a clear upward or downward direction. Statistically, a trend is more likely to continue than to reverse. This is why a trend is assumed to be in effect until it gives a clear signal that it has reversed. Hence the sayings, "The trend is your friend," and "Never go against the trend." By following trends over different time frames and staying away from markets when they are not trending, traders can increase their profit-making opportunities. There are three decisions confronting a trader: when to buy, when to sell, and when to do nothing. Now that you know what trends are, you should only buy in an uptrend, sell in a downtrend, and do nothing in a range. Time frames. Traders often feel confused when they look at charts in different time frames and see that the market is going in several directions at once. The trend may be up on the weekly chart but down on the daily, and vice versa. So which of these trends should you follow? To understand more on this subject, let us see the following. The market has three movements. The main movement, which lasts for more than a year, possibly several years, and can be bearish or bullish. The secondary or intermediate movement, which represents corrections in the primary trend and usually lasts between 3 weeks to 6 months. And the minor or near-term movement, which in turn represents corrections in the secondary movement and usually lasts less than 3 to 4 weeks. In our next video, we will talk about trend lines. Thank you for watching.